So as the pressure mounts in Washington to make a deal by year-end, the U.S. could still be facing years of trillion-dollar deficits. So how should investors prepare portfolios for this runaway spending? Paul Dietrich, Foxhall Capital Management CEO, joins us in this Fox Business exclusive live from Washington, D.C. Paul, thank you so much for joining us. First, give me your basic advice for everyday investors. How do you sift through the noise being created by all of this talk and negotiation back and forth on the fiscal cliff?
Well, almost the consensus is here in Washington that everybody believes that there will eventually be a deal. The problem is that the Republicans are in an exceedingly weak negotiating position, and in the end, the deal that's going to be cut is still going to leave investors with $1 trillion to $1.2 trillion in deficit spending and printing money every year for the next 10 years. And the only way an investor is going to be able to hedge the loss of buying power in his portfolio, his or her portfolio, is by investing in gold or gold mining stocks like GDL or GDX. Okay. And
I'm sorry, I was just kind of chuckling to myself. I always, the gold plate's like, well, buy those bars of gold, bury it in your backyard, buy those assets, buy real things.
I think the answer is not to be buying bullion, but to be buying like GDL ETFs and GDX. And in fact, our firm this week is bringing out a new mutual fund, the Fairfax Gold and Precious Metals Funds, GOLMX.
Let me challenge you on the gold, though. The miners really haven't done much for years, though.
They go in a cycle, and they are historically undervalued to gold right now. And for those people who are looking for gold not as an investment to trade, but are looking at it as a hedge over time for their portfolios and the loss of buying power, this is really the best way to buy gold, because you're buying gold at a fraction of the cost of bullion.
Do you think we will become energy independent as a nation, and would you be investing on that theme?
Yes. I'm looking at several trends over the last 5 or 6 months that really seem to be accelerating, and one of them is energy. We are going to probably be energy independent in the United States because of all the new technology and oil fracking and natural gas fracking. We've created 33,000 new jobs in the last few months. And also, there's an enormous amount of private infrastructure that's being engineered right now for pipelines to get the new gas and oil from where it is into the pipeline system.
So the best integrated energy, ExxonMobil?
ExxonMobil is the choice for that particular trend.
Okay, let's move on and talk about some of the grains. I know you've got some picks in agriculture as well.
Yeah, agriculture products are going to continue to go up. Not only do we have weather problems, which are going to be continuing probably, but it's the demand, especially from Asia. As millions of new people, it's all demographics, are moving into the middle class. They want protein, and that's the sort of products that America exports. Farmers, the Midwest, these people are going to benefit for the next 20 years on this trend.
So this is your
I think Monsanto. I really like Monsanto. I think that's the best biotech company in the world, and is going to play a major role in creating more and more productivity per acre for farmers.
And are you looking solely at the U.S. domestic investments? I mean, you've got to work multinationals into this as well, right? We were talking with the CEO of AGCO earlier this hour, who's pointing out how they're offsetting with the BRIC countries, even investing in Africa because of challenges here in the U.S.
There's no question about it. And there are a lot of people looking at agricultural land in Brazil. That is another big area. And I think this is going to expand. But the demographics, especially in Asia, are outstripping the supply, no matter how fast we start turning land into productive land.
Good info. Paul Dietrich of Foxhall Capital Management. He's the CEO there. Many thank you, sir.